joining us to this Dr. Well Beat and Ask interview. Oh, it's live now. Okay. Thank you for joining us at this Dr. Well Beat and Ask interview series. All right. Today, my guest will be Rayner.
Wait. I don't know whether we have started.
Yeah, we started already. Okay. Yeah. So it's as live as we make mistakes along the way. Okay. So today I'm with Rayner. Right. Thank you for his time to join us today. He's from tradingwithrayner.com. Okay. So he is a proprietary trader. He used to be, right? Now he's an independent trader. And what I'm most amazed about him was that he created so much content and he published them free for a lot of traders around the world. And he has amassed a lot of followers on his YouTube as well as his Facebook community. So we are very honored for him to come here tonight and share with us more about trading mistakes that we can learn from, so that we don't pay them ourselves, right? And yes, Rayner is with us. Hi, Rayner.
Thank you, Elvin. Right, the pleasure is all mine, and I'm happy to be here today. Thank you so much.
Okay, thank you. And we know that you have been trading for many, many years, right? And also know you for a few years. And you're one of the more credible guys out there that's really giving a lot of value to the trading community, right? What made you start this journey, right? To really create so much things to help other people?
Okay. So, well, I guess we all have to start somewhere. So I started back in 2012 period, right? So back then, I was working with the prop trading firm and had a little bit of free time on my hands. So wanted to do something productive like instead of just watching the markets all day, because sometimes there's no opportunities. So I figured, why not create like a journal, an online journal, to kind of share my thoughts and process it, stuff like that. So that's how the blog came about. Then from then on, one thing led to another. I started producing a weekly video just to share my thoughts. Then apparently people kind of enjoy it. So that is pretty much how we got started. Just baby steps. It's just basically for my own self-improvement, and along the way people enjoy it, and I slowly started to share more and more till pretty much where we are today. Yeah.
Oh, okay, actually, I have a similar story, right? Because I also started out more like an online journal, really to document what I've learned. And somehow I also stumbled into it. It seems like there's an audience out there, right? And I also was quite surprised. But I guess it is also part of the motivation for you to keep going, right? Because if there isn't an audience, it's very hard to continue producing a lot of content.
Yes, exactly. I mean, if nobody's watching, right, then you're after a while you kind of wonder, why am I doing all this? So at least people engaging, people say thank you, people who are going through the same journey as us, then that makes the sharing much more rewarding in a sense. Yeah.
And I also noticed that you have a rather big international followers, which is unusual, because most of our Singapore bloggers or influencers in the finance side, right, do not really have a huge international followers. Most of them are either Singaporeans, or the most we get are Malaysians. So how or do you know which countries, right, that there's outside of Singapore and Malaysia, the next most most number of followers from that place?
Yeah, sure. I think the top three is number one is India. India is number one, followed by United States, and I believe the third one is probably South Africa or Nigeria. I can't remember which. Yeah, so it's actually quite interesting. And Singapore is like number 5 or number 6. It's not really.
Okay, I mean, so it's still not number one.
Not number one. Not even number 3. Yeah, it's 5 or 6, I think, around there. Yeah.
Okay. So do you have any idea how do you even get them to know about you and follow you? Because it's not usual, as I said, due to home bias, we tend to follow people who are in the same country. But your first 3 are not Singapore.
Yeah. So I suspect is number one is the market. So I a lot of my things that I talk about, like the blog of video, it starts off with FX. So FX, I think, is kind of borderless. Doesn't matter whether you're in Singaporean, South Africa, India, or whatsoever. So that's number one. Number two is, I guess, in those countries, maybe the people down there or the educators down there, they don't really share, maybe, I don't know, as much. I mean, I don't want to, not to say their educators, they are bad, but maybe they just don't go into it as the way I do it. Maybe just my approach is just kind of resonate more with them. I'm just guessing that way. So that way the markets, number one, is borderless, and number two, they resonate with the things I share, and maybe that's why they enjoy my stuff. Yeah.
Okay. Yeah, because I'm still very amazed by that, right? Because we have an Asian accent on the English, but you do have a lot of Americans that following you, right? So that's really fantastic. Okay.
Yes,
Yeah,
yes.
because even for us, we don't get a lot of Americans. Yeah.
Correct. I even thought that the accent might be a put off because the Singlish accent is I can't remove it. It's after all I'm from Singapore. So, but apparently people still can go through the accent and they're okay with it. Yeah.
Okay. And there are so many career choices, right? So how do you even like stumble into trading in the first place? Was
Okay.
it like your
So
first choice?
yeah, in a way, yes. It's always something that I always wanted to do since the army days. I wanted something that is should I put it? Something that doesn't have a cap on how much you can potentially make. I mean, after all, if you work in a back end office job in the bank or whatsoever, you're a cost center. There's only so much value you can deliver to the bank, and because your value is limited to your employer, there's only so much you can earn. So I wanted something that's kind of like unlimited upside, and somehow trading was the thing that made the most sense to me. Like hey, the sky is the limit. You can be your own boss, blah blah blah, and that was kind of like the attractive point to where I got started. But then after you go down the journey, you realize that there's a lot more than that, just unlimited earning potential. Yeah.
Okay, so that made you join as a proprietary trader.
That's right. I wanted to
first,
learn how those guys do it. So I figured, why not just join a company who actually does it for a living and learn everything I can down there. Yeah.
Okay, so what were you trading at
I was
first?
trading the Nikkei futures at the start. Yeah.
Okay, the Japanese indices.
That's right. The Japanese stock market index.
Okay. So if you can remember, what was like the major thing that you took away from this proprietary trading experience?
I think the biggest takeaway I had is that this is not something that I want to do in my 50s or 60s because, in front of the monitor, 10, 12, 14 hours a day, when you're young in your 20s, you can do that. But when you have wife, you have kids, I don't think that's a trading, all right, I don't think that's a career you want to do it in your 40s, 50s, or 60s. So at that point, there was a kind of like a revelation to say that I needed to switch style. I cannot be, trading such short-term approach. I got to, trade something longer term. And so that's where my approach shifted. Yeah, when that
So
hit me.
essentially you were doing intraday trades.
Yeah, a very short-term
trades.
Yeah, day trading. Yeah, entering multiple times a day. That's right.
So which means you have to watch the charts every day, every moment.
Yeah, for most of the time, yes. Of course, sometimes lunch period is quite quiet, so you can do your own things. But otherwise, yeah, pretty much 10, 12 hours a day in front of your computer is not uncommon.
Okay, and that's how you realize that you need to trade a much longer time frame, right? So
Yeah.
What kind of time frame are you talking about right now?
Oh, so right now I trade from 4 hour daily, weekly, and even monthly. It depends on the strategy itself. Like maybe let's say if I have like a systematic rotational strategy, that could be a monthly time frame. If I do something more of a discretionary trading, that could be the 4 hour, 8 hour, or even the daily time frame. So it depends on the strategy itself. Yeah, there's no one specific time frame because there are multiple strategies that I adopt myself. Yeah.
Okay. And if let's say we just put it in a month, how much hours are needed to put into trading, at least for yourself?
Oh, for myself, it's not much actually, because I would say a lot of the legwork has been done before that. So if you talk about, let's say, systems trading, right? I mean, in a day, I probably spend I think less than 10 minutes on systems trading, and that's not to say that all you need is 10 minutes a day, because a lot of the R&D has been done before the execution, like, testing the strategy, the back testing, forward testing, the programming part, liaising with the programmer, because I can't program. So I liaise with the programmer. That will take, weeks or sometimes even months till where I'm confident to trade a strategy, which now pretty much takes like 10 minutes a day. So yeah, now it's about 10 minutes a day for systems trading, but the R&D before that is a lot more work. And that's just for systems trading. For price action trading, which is otherwise known as discretionary trading, that usually take about 2-3 hours a week, right? And again, that one, the bulk of the work is done on the weekends and the weekday when the market opens. Again, doesn't really take much time because, again, of the higher time frame that I'm trading on. Yeah.
Okay, so just to help our audience a little bit, because they may not be so conversant with trading, and when you say system trading, right, how would you define it as simply as possible?
Okay, so it's basically in trading, there's pretty much two fields. One is discretionary trading, one is systems trading or quantitative trading or algo trading. So that systems trading, that approach, right, is very mechanical. So meaning the rules are black and white. It's like, for example, if the price breaks above the 52-week high, you buy. So it's very clear. If 100 traders see that rule, 100 traders will do the same trade because it's just, 52 weeks high, you buy. So that's one example. So on the other hand, discretionary trading is where it gets a little bit more subjective, where if 100 traders see the chart, right, they might have different interpretation of it. Maybe 50 or 60 might say they want to buy, 30 say they want to sell, maybe 10 are undecided. So that's more towards discretionary trading, where there's an element of subjectivity. Yeah.
Okay. So it sounds like what we have been doing at Dr. Wealth as well, right? So we won't say we are like 100% rule based, but we do have a set of principles to follow. So we're almost like 50 to 70% rule based, and part of it is discretionary. I do know that sometimes people prefer to be 100% either way, lah, right? So
Yes.
Rayner, you are more 100% on rule based. Are there even a slightest discretionary things that you do?
Yes, definitely. I have about right now it's about 70-80% of my money is systematic trading. The other maybe 20-30%, right, is for the discretionary trading. So my trading is kind of like segregated into two different components. One is where I don't even think, right, they just follow the rules, and the other one is where there's a little bit of element of subjectivity where it's based on my interpretation of the charts before I make my buy and sell decision. So yeah, right now it's actually in two different camps.
Okay. And would you say that discretionary trading is only suitable for more experienced traders? And because as a newcomer, right, it might be very difficult to have that kind of basis to make your own decision without any rules to guide. Would you say so?
I would say, yeah, in a way, if you just, let's say you have two traders and you want to teach them how to trade profitably, right, I would say, well, again, it depends. Because some traders I know, right, they want to go with the discretionary trading approach. They find that they enjoy analyzing the markets. They find it intellectually challenging. Then on the other hand, I've seen traders who prefer to not think, right, just follow a set of rules and they'll follow it, and in the long run they make money. So I can't really say whether one approach will be easier than the other approach, because I feel that it really depends on the trader, what resonate with them, right? So some traders, again, right, I can't force them to say, hey, you just follow these rules, right? Don't have to think. But maybe today I want to analyze the chart, I want to, read the price action, right? So following a set of rules doesn't sit well with them. So yeah, I can't say, whether which one is easier or not. Yeah.
Okay. So it's up to the individual preference, lah. That's how you will.
Yeah, I would say so.
put
Yes.
it, lah. Okay.
Yes. And I
Because
find that.
Sorry, go ahead.
Yeah, and I would say, based on my experience, I would say that a lot more traders prefer the discretionary trading approach because it's sexier, I guess. There's more tools, there's more techniques, there's more things to look at, whereas the systematic approach is quite dry and boring. It's not sexy. So that is where most traders kind of shun away, because there's nothing to do. It's just following the rules. It's boring. Yeah.
Okay, so then the next question I have is that do you find more successful traders using systematic or discretionary methods?
Based on what I'm seeing, I actually see that, I think, based on the traders I follow on Twitter, I find that those adopt a systems trading approach, they are more, in a way, more, how should I put it, transparent, because I mean they can share their results based on their algorithm, right, the backtest results. So in a way, they share, how their systems actually fare over time historically. Whereas the discretionary trader, I don't really see that much. Maybe because it's personal, maybe because they don't have the tools to do such backtesting. I do not know. So from what I'm seeing, I would say there are success in both camps. I have seen, right? So yeah, I can't say which is more, but I find that the systems trader, they are more quote unquote transparent in the sense that they can actually share the details of their strategy, the breakdown, because the tools that they use actually support it, and it's easier to share that. Yeah.
Okay. That's a good point. Because discretionary usually is you can say whatever you want, right? After
you can use your Microsoft Excel and put whatever numbers you want. Where so that's yeah.
Okay. So you are more of a system guy, right? And I believe that your strategy is more like a trend following, right? Because in trading, there are also many different kind of approaches. There's also the opposite side, which are mean reversion trades, right?
That's right.
Okay. So what would you say are the advantages of employing trend following?
Okay, so maybe just share. So yeah, you're right in the sense that I am a trend follower, but I would say over the years, right, I've also traded multiple trading systems because I realized that as an individual trading system, right, you will have, periods of drawdown, and to kind of like compensate that, the free lunch, right, is where you trade multiple trading systems. So maybe we can get to that part later, but back to your question, trend following, right? The biggest advantage of trend following is that it is a very good hedge, right, in crisis period, like for example, financial crisis, recession, right? Trend following, I'm talking about the futures trend following, that part, right? Yeah, that type of trading strategies tend to do well because that's where a lot of our markets tend to trend together. So like, let's say market collapse, bonds could rally, safe haven currencies could rally, gold can rally, and the trends are quite pronounced because there's a lot of fear in the market. So that's where trend following shines. However, in normal period, like let's say bull markets in equities, right, trend following may not be able to match that returns during bull market equities, especially over the last 5 years or so. Trend following, I would say, has underperformed the stock markets. Yeah, but that said, right, trend following is definitely a very useful strategy to have, right, as part of your overall portfolio, because when stock markets get beaten badly, right, you have something that actually provides a form of diversification. So you kind of like contain the damage, right, instead of having all your money in the stocks. Yeah.
Okay. And what do you trade primarily?
For trend following, okay, so for trend following, I trade different sectors, about 40-50 markets. So the broad-based markets I can say is FX, that's one. Commodities, hard commodities like metals, gold, platinum, palladium. Then you have soft commodities like wheat, soybean as well. There's another one. Then we trade the bond markets like the 5-year bond, the 10-year bond, the JGB, which is the Japanese bond. And the other one, it's the what's it? Let me check. I broke down the sectors. Let me just see what I call them.
So mainly you're talking about there are more macro kind of instruments, right?
Yeah,
At the asset classes level.
that's right. So for
Instrument
example,
level.
exactly. So I have one, like for example, a sector called agriculture, where I trade all the agriculture product like soybean oil, soybean meal, Chicago wheat corn. Then we have bonds, currencies, indices, and non-agriculture like gold, silver, palladium, etc. Yeah.
So I suppose they are futures contracts.
Yes, but the thing about this is that for futures trading, right, your margin requirements is very large to trade so many markets. You probably need like a mid to high 7 figures account. So what I do is I trade forward, so that way a smaller account size, right, can trade it as well. Yeah.
Okay. And we know that people, when you talk about investing, they straight away will think about its stocks. Okay. So do you trade individual stocks?
I do. So that's under the systems trading, where certain trading systems trades these stocks, and it depends on the strategy. For example, one of them I have is what I call the Momo stock trading system. Basically, it's a rebalancing. So basically what it does, right, is it identifies the strongest stock out there, right, and it buys and holds them for at least a month, right? Then what it does is that the next month it starts to look and see whether these few stocks are still strong or not. If they are not strong, I sell them and buy the next few strong ones. If they are still performing if they are still performing strongly, I hold them and and see how strong they can go. Yeah, so that's one of the stock strategy that I trade off, which is basically momentum, if you want to put it that way. Yeah.
Okay. So are there differences between trading individual stocks and versus if you trade indices? Are there differences or are they similar?
I would say, in the grand scheme of things, stocks, their behavior tends to be mean reverting. So what that means is that let's say stocks drop like 4 or 5 days in a row, more often than not, right, it tends to rally and continue heading higher. So that's the characteristic of the stock markets, whether you're talking about indices or large cap. I can't say the same for penny stocks or small cap stocks because I haven't done research on that. But generally, that's how most stocks behave. They have a mean reverting behavior, meaning they tend to pull back, then continue higher, pull back and continue higher. Of course, there are recessions, there are crises along the way, and that's invalidated. But more often than not, that's the characteristics of stocks. Yeah. So does that answer the question? You said.
Are there differences with individual stocks, trading individual stock versus trading indices?
Yeah, so generally they have this behavior, let's mention, right, for large cap and indices. But of course, when you break down stocks into, like, let's say penny stocks and small cap stocks, right, they would behave very differently from the main index already. Yeah.
Okay. Yeah, because indices are essentially made of big cap stocks.
Yeah, that's
most
right.
people are familiar with.
Yeah.
So because you trade both, so there isn't much differences between the two.
Yes.
Okay. And yes, and we are supposed to talk about trading traders' mistakes, right? Common
Oh
trader
yeah,
mistakes.
that's
Okay.
right.
And I asked you about that, and you said there were at least 5 of them. So maybe you can kick off with the first one.
Okay, so yeah, there are five main ones, but there are definitely a lot more. But I'll say these are the five main ones based on sharing with trader over the years. So the first one is not having an edge in the markets. So what is an edge, right? So an edge is whether you're trading or investing, you need something that is mathematically in your favor. So for example, you go down to a casino, right? You will be losing, right, no matter what, because the house has an edge over you. So whether you're trading or investing, you've got to have a strategy, a system, right, that has an edge in the markets. So the next question I'm going to get is, hey, Rayner, how do I find an edge in the markets? So I always tell traders, don't try to reinvent the wheel. There's a lot of resources out there where you can study, right? Take the resources and actually tweak it and make it your own. So one simple way is, you go down to Amazon, right? You can search for trading systems books, or for example, one of them is Andreas Kleno, following the trend, Nick Rech, Unholy Grails, and so much more. Take those books, borrow it, buy it, rob it or whatever, and study the trading systems. They are good in the sense that they actually share with you why the trading systems work. Okay, and that's to help you believe in the system. Then what you want to do next is to go and validate the systems, right, to see whether it actually works or not. Like how you can do it is hire a programmer to do the programming if you do not know how to program. If you know how to program, great, right? Then do it yourself. Yeah. So from then on, right, you can tell whether the systems that's being shared, it works or not, right? So generally, those people who actually post up their systems out there, I would say about 80% of what they share actually do work. They don't work every week or every month, but in the grand scheme of things, long term, they actually do work. And it's because usually of some behavioral bias, like fear of missing out, fear in the markets, etc. So I would say that's the easiest way to get started, right? To get an edge in the markets. And that's the first reason why traders feel they don't have an edge in the markets. They think they just, buy, sell, buy low, sell high, I'll make some money. But the thing is, when you buy low and sell high, your buying decisions, the thought process, right, could be different from the next time you buy and sell. Right? Sometimes could be due to fear, sometimes could be due to your broker's tip, sometimes could be due to social media and whatsoever. So yeah, you must have an edge in the markets. That's the first thing.
Okay, there's another resource that I think of is tradingwithrayner.com as well as his YouTube channel. A lot of good stuff.
Yeah.
So you don't need to start from scratch. We stand on shoulders of giants, right? So don't
Yes,
reinvent
I
the
like that
wheel.
one.
Yeah, and just go and start somewhere, right, rather than from scratch. Okay, and you mentioned about the those people who do not usually have this edge, right? They tend to be more speculative in nature, right? And they may just get sources from social media here and there and then try to figure things out. And every time they enter and exit, their considerations are very different, right? So that links back to what we talked about just now about discretionary kind of trades, right? So that's my view is that it tends to make beginners uh, abuse this power, right? This freedom of making a decision. So they end up, right, always make the wrong decision, right? Like what you mentioned, they can listen to their fear, their greed, whatever, without them even knowing, right? That's the most detrimental part. And when you talk about back testing, hiring programmers, all this, right? I can even feel that a lot of the audience will be feeling like, really, so much work out there. You mean I really need to hire somebody to do the back testing for me? Are there like tools that they can just run this test on certain system, whatever?
My take is that if you look at it from the grand scheme of things, I'm guessing the audience here are like 30 years old and above, and you're putting pretty much 5 figures, some even 6 figures in the market. This means that your losses could be anywhere 5-6 figures. So trust me, right? Hiring programmer to do all this backtesting work won't even reach 5 figures. I would say 4 figures, $2,000-3,000. You can pretty much test one or two systems very extensively. So I don't recommend the free tools, and the reason is being free has its cost, right? Number one, the data could be filled with error. Like you take data from Yahoo or Google. I mean, I won't even trust the historical stock price. So that's one. And number two, right, those software that help you do free backtesting, it's very limited. Maybe they can just do some simple moving average crossover, and that's it, right? That's not enough. So I would say take this as investment, right? Invest in good quality data. Invest in programmer that can help you, backtest your system. This will pay dividends in the long run. Yeah.
Okay, so I believe part of the back testing is also to build the confidence in the system itself, right? Because if let's say you're just using somebody else's system without seeing the results for yourself through a back test or what, right? if let's say the strategy hit a rough patch, it's very easy to give up. Is that also one of the pros of doing your own back test, that you actually build confidence in the system that you try to develop?
Yes, I would say that definitely helps because you know, right? Like, let's say based on the last 20 years, what is the worst results the system produce? And let's say right now, if you're in a drawdown and you realize that it's only halfway through compared to the worst period that you have, then that instill confidence that, man, I should still continue trading because last 20 years, this actually happened as well, but it's even worse. So right now, I'm not as bad. So I should actually continue trading the system. And the other second component, which I find very important, is that you must understand why your system makes money. Because if you take a system and you just trade it blindly, even though the backtest results are good, but if there's no logical reasoning behind it, it's very hard to, trade it consistently as well. Because there's no belief in the system, there's no conviction. So yeah, the belief, the reasoning to why a system should work right needs to be there as well.
So, okay, so that's interesting. You're saying that there should be like even a theory why it should work, right? And it's not just purely based on whatever the backtest result mathematically or technical indicators that say so, right?
Yeah, there should be a theory behind it. Yes.
Okay, so something like what you mentioned, the human greed and fear, the biases that's inside, something along that lines now.
That's right. Yes.
Okay. So that's interesting, right? So it's not just find mechanically any strategy that gives you an edge without knowing why there is a way that makes it work, right? So that will also help you with your confidence in the system, right? Especially you run through a rough patch now. Right?
Yes, and also this is just based from my own opinion because I know of other traders out there who trade systems without any logic, but they still continue trading it anyway. Like for example, Renaissance Capital, Renaissance Technology, right, one of the biggest hedge funds in the world. They just exploit patterns in the market, no reason, no logic. They just do it anyway, and they rake in billions of dollars each year. So this is a disclaimer. It's just my own opinion, right? I'm not a HFT firm, so I have to have a logic for me to trade it. Yeah.
Okay. But I guess it makes sense, right? Personally, I will also relate to that because if I do not understand how it works, right, it's very hard for me to accept it. Like even when we drive a car, right, we also want to roughly know how a car works, right? You won't dare to like just hop onto a machine and then just press on this pedal and then you'll go, right?
Yeah.
So I guess it's part of the confidence building. Okay?
Definitely.
Because I find that the hardest part for any trading or even investing, right, is always when someone hit a rough patch. Right?
Yeah.
That's always the hardest part of the process, to go through it and to come up on the other side. Most people will just give up along the way.
Correct. That's why I feel that having a community of traders who are doing it together, right, to overcome the so-called obstacle together will help strengthen their conviction of the system. Especially if they can overcome, let's say, an 08-09 financial crisis. I'm pretty sure that they can stick to the system for many years to come once they can overcome that one. Yeah.
And how about the second most common mistake that you have seen?
Okay. So by the way, right, the 5 mistakes I shared, I won't say I rank them like 1, 2, 3, 4, 5. They are just in a random order. So the second one is not committed. I find that traders or investors, the why they lose money because they're not committed. They just take it like a hobby. Let's dabble. Let's try this. Let me try forex. When I hear the word "let me try forex," I know liao. It's game over. This is not gonna make it because they won't have the perseverance to stick through it, right? Or let me try to play stocks. What play stocks? It's not play. It's not game, right? So yeah, you got to be committed from the start. I think it's just like anything else you do. Like if you want to be a doctor, right? I'm pretty sure that you got to be committed to pass through your medical degree, your doctorate or whatsoever to get to wearing the white coat. Yeah. If you want to be an engineer, if you want to be a lawyer, if you want to be an athlete, professional athlete, whatever, there is a commitment to you have to be committed to it, right? If you are not committed, then just get a regular job, right? You can just put in a half-baked attitude and you still get a paycheck every month. But trading, investing, the markets, we are competing with some of the richest, the best, the smartest people out there. You have to be committed if you want to stand a chance to make money from the markets. Yeah.
Okay, so I guess committed is more of the mentality, right? Not so much of I'm committed. I'm going to sell all my house and just put all the money in trading, right?
Yeah.
So commitment,
the mental.
what you mean? Yeah, it's a mentality. Okay, just to make sure people don't get the wrong lesson from this. Okay, and obviously because I'm also in the investing field, met a lot of investors, and yes, I also see that kind of commitment level is usually quite low, because they tend to see investing or trading like it's a side thing, right? My main thing is still my career, my business or whatever, right? But at the same time, they still have that little bit of I want to make some money on the side, but I don't want to like take another job, you see. So using money to make money sounds very good, right? Which means they are already approaching the markets with a mentality or attitude that I want to do minimal work, right? I don't
Yes.
want to put in so much effort. Okay.
Yes.
It's supposed to just churn money for me. I'm just supposed to risk my money there, right? So probably that is the reason why they don't spend enough time to think about their position, to think about how they enter and exit, or whether to think about do they even have a system that gives them an edge for them to reap a long-term reward, right? So what does a new guy who has a lot of commitment or how do you know whether a new guy, right, has this commitment level? Is it obvious to you when you
I
meet
mean,
someone like this? How
I
do
usually
you tell, right? So that maybe in the audience, maybe they can picture whether they are like this, you see, whether
okay.
they have that commitment.
So from what I see, because I don't really meet a lot of traders one to one because I do a lot of things based online. So the biggest telltale sign I see is that the questions that they ask, those really committed ones, right, ask a lot of questions, a lot of detailed questions to find nuance to why you do this, why you do that, and they just keep emailing and asking questions. Yeah, that's I would say the more committed ones. The non-committed ones are ones that very passive. I think this works. Let me try this. Ah, yeah, lazy to ask. No need to ask. And so yeah, so basically the way they engage you, the number of questions that they ask, right, can let you know, right, how committed they are. Yeah.
Okay. So they are very paying a lot of attention to details, really dig deeper and try to figure out what this means and that means.
Yeah,
Okay.
correct. Exactly.
Right. But I guess because you have a lot of students, right? So I definitely believe these are not the majority.
You're right. Yeah, you're not right. You're right. Most of them are just passive. I'm nothing bad against them, but they're just passive. I think most people are just passive. Let me just study a course. Let me see how it goes. If can, okay. If not, then never mind. So that's the kind of the attitude that I'm seeing mostly.
I think it's also because of the society we lived in, right? So it is also those people who are able to invest or trade the market. Usually, they are the more better off people, right?
Yes,
Because
that's true as well.
they have capital, you see. So I think that becomes a problem as well at a commitment level because they don't see a need to really succeed in trading or investing because they always have something to fall back on, you see. Yeah, and that usually erode that kind of commitment level that's required of them. But if you die, right, you have to make trading or investing work for you, right? You will definitely be very committed.
Yeah,
So
that's right.
yeah, so I guess it's also a first world problem that we have when it comes to trading and investing, right? And it's something that you cannot use money and buy, right? It's really it comes from you when you decided to really I want to do this properly, right? And
Yeah.
you just take that decision to really do it in the right way.
Yeah, I totally agree. Yes, it's kind of like, you're already at a certain level of comfort, I mean, even if I don't make it, doesn't matter. My life still goes on. I'm still can pay the bills, feed the kids, so yeah.
Yeah. Okay. First world problem. Okay. How about the third mistake?
All right. So the third thing is no risk management. So yeah, this is a lesson that I learned from okay, I sorry, I want to say Jack Schwager, but I learned that one is more of the having an edge is from Jack Schwager. So no risk management, basically, you can have a trading system that works, but if you don't bet in a conservative approach, right, then guess what? You could still lose money. So it's very simple. Like let's say casino, for example. Why casino they have table limits. Like casino they make so much money each year. Why do they want to limit the people from betting so much? Because they have risk management. They know that in a short run, casino could lose money, and if they don't control the size of the bets, right, that they allow the customers to make, they could potentially lose a lot within a short period of time. So casinos have, even the house, they have an advantage, but they still adopt proper risk management. And it's the same for investing or trading, right? Let's say trading, right? You have $100,000 trading capital. If let's say you put on $50,000 on that one trade, guess what? If you're wrong 2 times in a row, right, that's pretty much it. Your capital is wiped out. And same for investing, right? If you have 100K capital, I'm sure you're not going to put that 100K into one stock, because no matter how much research you do into that one stock, right, you have no idea what goes on behind the scenes of a stock. All right. So that's why it makes sense to diversify your stock holdings. For example, Warren Buffett, I think you can see the list of stocks that he holds. I think it's like 40 or 50 or maybe even more. He buys so many different companies. He doesn't go all in into one or two stocks, because no matter how sure he is, right, something can go wrong company or the economy or whatsoever. So risk management is key, right? Yeah, don't put everything. Don't go all in into one or two companies or one or two trades. That's the surest way to lose everything. Yeah.
Okay. Is that common in trading that they put a lot into one or two position?
It depends on what type of trading. For FX trading, they take leverage and go all in, so they lose even faster. So if you talk about like cash trading, then yeah, it's quite common, right? Because especially those who are undercapitalized, those that have like $200, $300. I can understand it's difficult to have proper risk management when your account size is so small, but it has to start somewhere, right? Even though you have $300, right, you have to adopt proper risk management, because as your fund size increase, that habit that you built on while you are very small, right, will carry forth, right, as you grow larger. And if that habit persists, right, then really, right, it's a recipe for disaster in the long run. Yeah.
Okay. Having 200-300, they want to do trading. Yeah, I can't think of it's really very difficult, right? It's almost like buying 4D already or Toto, right? I just want to gamble this, and if I have a windfall, then I make it, right? If it doesn't, then too bad.
Yeah, it's like, okay, like 200, 300, I can survive with that, 200, 300. So they take it like gambling. Like, you go to a casino, you roll yourself with $200, $300, lose it, never mind, right? Then you just fund the account again, another 200, 300, 300. And in the long run, it accumulates over time. So yeah, risk management, if you're serious in this business, risk management has to be there from day one. You cannot treat it like going to a casino. I lose 500, so be it. No, cannot. That's not the way.
Okay.
Yeah.
So risk management, what you mentioned is more like a position sizing, right? At this point in time. But
Yeah,
I think there's another one which is using stop losses to predetermine where you want to take off a position if you're wrong, right?
correct. So there are multiple ways to it. Some people use stop losses, especially when you're doing leverage trading. Stop losses is essential because you are trading with leverage, right? And you could lose more than you actually invest in. Whereas for stocks, right, if you're trading on cash, then stop loss is something that is may or may not, depending on how you manage your risk. Some people use a portfolio rebalancing approach, like I mentioned earlier. Every few months, they turn over their portfolio. Some might use might trade options, and options has already a kind of like a built-in stop loss for call options. I mean, they expire worthless, it's worthless. Yeah, then some traders use a time stop where after a certain number of time, this thing doesn't happen, they manually sell the position. So there are many ways to manage your risk, right? But the key thing is that you got to have a plan exit ahead of time. You got to, make sure that even if you lose, it doesn't wipe out 40-50% of your capital. That's important.
Okay. So there are many ways, right?
Yeah, many ways.
And,
Yeah.
and you see again, we need to study just on risk management alone, right? There are so many things to really think and implement to your context.
Exactly.
Okay.
And that's why you got to be committed from the start. If you're not committed, right, you won't be going through all these details. All these will be very dry to you, boring. Let me just go to the action. Let me click buy. And then, that's, that's usually how it
Okay.
starts.
So commitment is more important than passion. That's what you're trying to say, right?
I would say you have to at least be passionate first before you can get a commitment, right? Because if you're not passionate about something, then how are you going to be committed? I mean, for me, if I'm not passionate, I can't be committed. So I got to have that passion first, then that commitment just kind of comes along with it.
Okay,
Yeah,
okay. So it's like you fall in love first, right? With a passion, right? Then after that you
yeah,
commit to a marriage.
yeah. Then you have you gotta go all in. Yeah, yeah. I mean,
Okay, all right. We are in the middle of the session already, and if you guys who are watching, you have questions, just type in the comment box. We will address them later. All right. So let's carry on. We are on the
all
fourth
right.
one already, right? The next
Okay,
one will
number
be the
4.
fourth
Yeah.
one.
So this is wrong expectation. So this kind of brings back to where you mentioned earlier, where someone has a full-time job. Let me dabble in the markets, earn an extra income. So the extra income part is very, very wrong, right? So I always tell traders or people out there, if you want to make an extra income, a passive income, don't get involved with the markets, because that's pretty much the hardest way to make an extra income. I think you work at McDonald's like so much easier. And why is that? Is because, right, making a consistent income from trading is difficult because the markets are always changing. I mean, you can, right? And the way to do it, right? The real way to do it is if you look at you got to study those HFT firms. How do those HFT firms make money almost every single day? And that's because they place thousands of trades each day, right? That's how the law of large number work in their favor. So some people might be confused. What is law of large number? Very simple. You take a coin in your hand right now, a 50-cent coin, whatever, and you toss the coin, let's say 4 times. In the short run, when you toss the coin, right, 4 times, it might be 1 head, 3 tails, maybe 4 head, 0 tails. But if you toss the coin 1,000 times, right, you'll get close to 500 hits and 500 tails, close to 50-50. And it's the same for trading. You might have a system that makes money, but if you're only putting like 1-2 trades a day, it's very difficult to make money every day because your age, right, takes time to play out. You need like few hundred trades, 1,000 trades for your age to play out. So in the short run, your results can be random. So that's why, it's difficult to be expecting to make money every day or every week because the size of the frequency of your trades, right, is just not enough for it to happen. So that's why, don't think that, if you want to make an passive income, a side income, try the markets, stay away from the markets. Yeah. So that's a very key important thing to take away. Not that it can't be done, but the odds are usually against you to do so. Yeah.
So it's linked back to the commitment again, right? Because if you lack that commitment, you just want to make a quick buck here and there. Usually, that's how it fails.
Yeah, in a way as well. Yeah, the expectations, the commitment, right? Because if they know that the money they make from trading isn't as easy as it seems, right? Then it will change their attitude towards it. If they realize that, man, you need a few years to understand how it works. You should instead of looking at making money each week, it's better to look at it at making money each year, right? So that will shift your expectations and shift your attitude towards the markets. Yeah.
Okay. For investing, I do see the similarity in having the wrong expectation, right? So what the kind of expectation I see is that, I want 20% per year, right? And they really think is every year I must get 20%. Right? If that year I don't get 20%, I'll be very upset, right? The stock market is rigged or whatever excuses that will come out. So yeah. So I always believe that the stock market is not here to serve you, right? So you have to suit what the stock market is willing to give you, right? Because at the end of the day, we are all price taker, right? The stock market is a price setter, right? They decide what kind of returns we are going to get, and then there's no argument about it, right? Yeah. So if you try to fight against the market, you try to believe that you're right. Usually, you end up very badly. You go, your pocket won't be deep enough to fight against the market all the time, right?
Exactly. Yeah. So a lot of times traders say you're gonna make like X% a year, 20% a year. But how the market rewards you is that you're not gonna get like 20% every single year. It's more like some years maybe you get 70, 80%. Some years you get nothing. Some years negative, then some years 10%. In the long run, you get 20%. But I almost never see that, years that you get consistently 20%, let's say 2-3 times in a row. It's very rare, even based on the results that I've gathered, the research. Very rare you see, back to back 20%, 20%, 20%. It's always fluctuate. The variation is just so high. So you just got to take what the market gives and control your downside when, things are not good for you.
But this is one of the reasons why you do multiple strategies, right? Because it's almost like diversification, right? Because one strategy may work sometimes, but it may not work another time. But with more strategies, you can smooth out the returns. Is that one of the main reasons you're doing multi-strategy?
That's the biggest reason. And the key thing is that you got to trade a multiple uncorrelated strategy. You cannot be trading all the strategy that is all like about the stock markets because there's not much correlation there. So it makes sense to be trading multiple uncorrelated strategies. That is key. Yeah.
Okay. So which means you will also do back testing for all these different markets, right? All these
That's right.
to make sure that they are uncorrelated.
Yeah, correct. You backtest all the strategies, let's say across 20 years, and you look at this strategy over the last 20 years, how this strategy has fared. This strategy, let's say strategy A has a losing year in 2014. What about strategy B? How did it fare in 2014? You want to make sure that strategy B in 2014 doesn't lose money because if their wins and losses, right, are very similar on a year-to-year basis, then the strategy is probably correlated and you don't want to be trading correlated strategies. Uncorrelated is better. Yeah.
Okay. And I think that leads me to the next point is that a lot of more novice kind of a trader, right? They tend to strategy hop, correct? Like usually someone who is more seasoned, they will run multi strategies at once. Okay.
Correct.
But a novice usually they'll run one strategy at once, and when it stop working, they hop to another strategy. And by the time they hop to a hot strategy that worked in the past, then suddenly it's not working. So they become like this vicious cycle, right? They just keep strategy hopping and they just go in at the wrong time and they just keep meeting failures and failures. Is that very common?
Yeah, actually, and this is actually my next mistake that I was about to share. Strategy hopping.
Let's go with that.
That's strategy hopping. That's the next mistake. Yeah, and how this works is that, again, right? So expectations. So from the start, people when they trade the markets, they think that there's a holy grail there. There's a certain strategy that if only they find, right, they will make money consistently, forever. And when they don't find it, they hop to the next best thing on forums, on books, or whatsoever. So yeah, this is what we call strategy hopping. And again, this kind of boils down to expectations. You have to understand that, very simple. markets, it goes up, it goes down, it range. Market conditions, it's always changing. And if conditions are always changing, then it means, right, no one strategy works all the time, because a strategy only works to exploit certain patterns, certain inefficiency of the market. When markets change, right, that strategy will stop working. So you have to understand that, nothing works all the time. So if you kind of like, you want to, hedge yourself, the best way is what we mentioned earlier, to trade multiple uncorrelated trading strategies. So in different market conditions, right, you have something that works to kind of like, hedge, right, something that doesn't work. Yeah. So yeah, strategy hopping.
But to trade multiple strategy, which also means that the capital must be of a certain size, right?
Makes sense, yeah.
And also that you need to do enough work to research and make sure they are uncorrelated and each of them have an edge, right?
Got to be committed. Yeah, committed.
Yeah, so
That's where
you
we
need
talk
to
about
be very
commitment.
committed to do
Yeah.
all these things before you even place your first trade.
Well, I would say for starters, you don't have to trade multiple trading strategies. Like for me, for example, I started off with just one strategy. Then over the years, I kind of built up from there. I mean, so I don't expect anyone to, from the start, trade 4 or 5 systems at one go. It's like, have one, master it, understand it, then bring another one to your toolbox. And over time, you can, trade multiple strategies. Yeah.
Okay. We have a question on from Raj, and he's saying that I think he's more of a long-term investor because that's what he mentioned, and he just want to find out, right? Is there any way to use trading principles to find market bottom and top? That's his question.
Trading principles to find market bottom and top. So
like just now you mentioned, right? Using trend following certain principles, it can help you avoid stock market crashes.
Trend following won't help you avoid stock market crashes, but what it does is that it helps you profit during crisis period. Meaning like strategies like stocks down 40-50%. Trend following that year could be up, say 40-50%. So that kind of like serve as a buffer to your losses in stocks. Yeah.
Okay. So is there any way to identify?
To be honest,
maybe not the lowest low, not the highest high, but if they can like protect part of their investments, right? Having some signals to exit, is that even possible?
I have absolutely no idea how to predict tops and bottoms, but I can share what I do is that I have seen research by Larry Connors. He wrote a book called I think Buy the Fear, Sell the Greed. But basically, you search. I can't remember what's the title of the book. I think it's, let me just do a quick search so I can share with you where the research come from. Health.
Because I do know some people, they use like moving averages, right, to identify turning points, right? Even though it's not perfect.
Yeah. So basically, let me just share with you. So basically, when I trade trading systems, stock trading systems, I will go into cash at a certain point in time. And the way I go into cash is based on just very simple stuff like price below, let's say, the 200-day moving average or the 100-week moving average. So basically, I have no idea whether the market will collapse, right? So I need to set a benchmark to tell myself, hey, market has been performing badly recently. There's a good chance it might go into recession. Let me move into cash. So one of the signal I use is the 100-week moving average. So if the index, like let's say the Russell 3000 or the S&P 500 is trading below the 100-week moving average, I sell all my stocks and I move to cash. Of course, right, there are times where it's just like a false breakout where, the moment it trades below the 100-week MA, it rebounds back higher. It happens. But more often than not, right, it helps me, protect my money during tough times. Because if you think about this, for recession to occur, right, it has to be trading at low prices. So you're going to determine at what point you want to move everything to cash. So for me, that signal, one of the signal I use is the 100-week moving average. Yeah. And also I have seen a research, right? You can search this person's name, I think Larry Connors. They have done research and they found that stocks, right, that are trading below the 200-day moving average, their median returns, right, are negative. What this means is that stocks trading below the 200-day moving average tend to continue heading lower, and stocks that are above the 200-day moving average tends to continue higher. So this is from a trading standpoint, right? I can't say the same for investing because that might be too short term for you. So that's just something to share, and if it helps you in any way, Raj.
So are you even comfortable like showing the 100-week, right? You're saying 100-week.
Yeah, sure. Let me show you. Okay, I can show you, but I need
just put it out so that they can have like a visual and then.
Okay. Makes sense. Yeah. So I can do a back test. I can share my screen, do a back test, and you can see what I mean. Okay, let's see.
Okay, for the rest, if you have more questions, please keep them coming and we can address them, right? We'll get Rayner to address them. We still probably have about 10 minutes more, right? So make use of the time, ask as many questions as you can. Okay.
Okay. So for this one, since this one runs the fastest, I use is a 10-month moving average. So is there a way I can share my screen?
Are you able to share?
Let me see. Maybe you have to like give me the power to share. Is there something like that? Share screen. Oh no, okay, I can do it. Yeah.
You can. Okay,
let me
great.
know if you can see it. Do you see it? My numbers on
Yes.
the okay. So yeah.
Yes.
So let me just walk you through. So this is basically the backtesting platform I use. It's called Army Broker. So you just you put in data to it. You run the data. You will spit out all this numbers. So there's a code behind it, but I think there's no point showing you. The key thing that I want to share over here. So this strategy, right, uses a 10-month moving average as a filter. So what happens is that remember we talked about a strategy earlier. Basically, it's the monthly rebalancing one. So before this strategy can even buy, right, it has to make sure that the index, okay, is above the 10-month moving average, which is highlighted over here. You can see over here the market timing length bracket month is 10. So basically, the Russell 3000 has to be above the 10-month moving average for us to buy stocks. If the Russell 3000 is below the 10-month moving average, we sell everything and hold it in cash. So you can see that I run this backtest from 2000 to 2020 end of June, and this is the equity curve of it over time. It's about the return is about 22%. Net return and the maximum drawdown is about 53%. This is quite large because of the dot-com bubble. But anyway, the key thing I want to share over here is that you see this period of, do you see this flat line over here? This flat line, not sure if you can see it. Yeah.
Yep.
So this is where this system went to cash. So 2008, right? Market collapse. A lot of people lost a lot of money in the stock markets. So you can see that because this system goes into cash when the Russell 3000 is below the 10-month moving average, you can see this line start to flatten out. It doesn't even move at all because we are in cash. So that's why we don't have to suffer the so-called drawdown that comes along with it. So there are a number of times we hold on to cash, even here as well. This little line that you can see over here, sometime in 2011, even recently as well. I'm not sure you can see this one over here. Like over the last few months when the market collapsed 30%, this system also went into cash before it started buying again. So yeah, this is how a simple trend filter can kind of like, protect your downside. Yeah. So I can't say that the 10-month moving average is best because there's no best out there, right? So you got to find a filter that makes sense to you. So for me, I use the 10-month moving average and the 100-week moving average. These two, depending on the systems that I trade. Yeah, hopefully that makes sense.
Okay, so I hope Raj, you get the answer. All right, so he just show you a system that can help you avoid, not say avoid, I cannot use the word avoid.
Using a trend filter. Just use a
to
trend
help
filter.
you move to cash and preserve your capital, right, during a market meltdown.
Yeah.
Okay. And we have another question from Sharon. How to manage trader psychology, although there is a price action and chart pattern? Might have a bad news on that day, might affect a trader not to enter a trade due to bad news. How to overcome that? Okay, so it's probably about emotional control, right? So maybe you have a system or rules, but that fear to pull that button, even though the rules say go.
Okay, so
how do you overcome that?
Okay, so couple of things to share. So number one, right, I am a firm believer that price is what pays, right? I ignore all fundamentals. I don't take into consideration the economy. I don't take into consideration GDP, stock news, analyst ratings, whatever. Zero, none of it. And because I'm a technical trader, so that's the first thing. I ignore all news out there. And also the second reason is that why I'm able to ignore news is because of the time frame I'm trading. I'm not trading off, let's say, the 5 minutes or the 15 minutes time frame. For traders operating on such short time frame, right, the news is important because they need to be aware of incoming news that's coming, and they know, maybe to stay out of the news in case, the market goes crazy and, stop them out of their trade. So because of me trading off the higher time frame, I have the so-called luxury to ignore news, right? And also because my trading style doesn't take into consideration news. And also another thing to share is that if you, let's say you go down the systematic trading route, right, and you do your backtesting, guess what? When you backtest, you only backtest the price on the chart, right? It doesn't know, right, at that point in time, what news is happening in the market. It doesn't know that, Trump become president. It doesn't know anything at all. And if you look at the historical results and you kind of see that, by ignoring news, right, and you get an equity curve that actually looks something like, say, like this, that should kind of instill confidence that, hey, maybe I don't really need to pay attention to news. Okay, so this is just my perspective coming from a trading perspective. Yeah, so that's what worked for me, and may or may not work for you. Yeah.
I mean, it is the logic can prevail when we are in a very calm mode, that we are not affected emotionally. I guess there's another layer of that question is that even though you know it's the right thing to follow the rules, right? And you
Correct.
should not be affected by certain news or whatever, but somehow you just happen to read it because your friend shared it on Facebook, and it somehow affected you emotionally. And what would you do? Do you even have such experience before, or you are really very zen about this? Then you do not have any episodes of such fear or greed that's crippling you.
I think, to be honest, in recent years, I have never really felt that way, because really I don't really pay attention to news anymore, and also, yeah, there are times where markets are bad, and for example, I have a mean reversion system that asks me to buy. Markets are collapsing. Am I really wanting to buy? I'll still buy anyway, because the backtest results has proven itself, and I would just buy. Because what's the point of doing all your testing, all your research, if you don't follow your rules, right? It kind of like defeat the purpose. So yeah, it's difficult, but it's the right thing to do. Yeah, and trading, right? It's all about doing the right things, not doing what's comfortable or not. Yeah.
Okay.
And interestingly, right, those good trades that I had, right, are usually times where it's difficult to pull the trigger. That's when there's a lot of fear in the market. It's difficult to pull the trigger, and those are the ones that actually, like, for example, this system that I just shared. I did face this problem in a way that, do I want to be buying? For example, you saw earlier, this one went into cash, and maybe a month ago it says to buy. Then at that point in time, right, it's difficult to buy because this COVID issue is around the world. People, there's a lot of fear. Airlines are closing, bankruptcy. But do I want to be buying? The signal says buy, but fundamentally it says don't buy. So again, right, because I've already done the work, I just pull the trigger and buy anyway. So that's my thought process. Yeah, wasn't exactly easy, but it needs to be done. Yeah.
Okay. So will meditation help?
I don't meditate, so I can't comment on that. Yeah.
Okay. I guess it's like if let's say someone find really because not everybody can be so logical, right, and disciplined. Okay, and some people the psychological makeup is more emotional. Then do you actually advise the person not to do trading?
I would say I wrote an article on this before, and I find that psychology, right, it's better managed when you are trading with money you can afford to lose. So let's say, for example, your entire net worth is, I don't know, $1 million, and you have 100K trading the financial markets. That's about 10% of your net worth. That's something that I would say it's easier for you to stomach, because your net worth is so high compared to someone who is trading 100K, but his net worth, let's say, is 150K. It's like almost 2/3 of his net worth. So if your size of your investment account or trading account is relatively small relative to your net worth, it's much easier to follow the rules, because after all, the damage, right, wouldn't be as bad relative to your net worth in the grand scheme of things. So I think know yourself better, know how much you can potentially handle, right, in the markets, right, relative to your net worth. So that's a useful benchmark to base on. If you're not sure, start with 5%, start with 10%. Even if you lose it, it's not going to ruin everything. Yeah, so that's something to consider.
But then they'll feel that if I put too little money, right, even if I'm right, I make too little. It's not going to make a difference to my net worth.
Yeah, so that's where we start to build on things. Right? Once you get comfortable, once you are confident of your strategy, then that's where you can put in, scale up over time, 15%, 20% to whatever amount you want to. Yeah. So, but you got to start somewhere, right, to see what is your own personal comfort level. Yeah.
Okay. And do you have any more lessons that anybody can take away from? Maybe just one more.
Yeah, the last lesson I had was actually strategy mismatch. So basically, the person trading a strategy that isn't suited for him. So for example, let's say, I think most of you all who are listening right now, you have a full-time job, right? Then clearly, you shouldn't be a day trader. You shouldn't be someone trying to scalp the markets, because your current circumstance, right, doesn't warrant such a trading approach, right? At the same time, if let's say you're someone who just graduated, you are maybe wanting to get a job as a prop trader, then it makes sense, right, to be learning how to day trade the market, since eventually when you get into a prop trading role, you will be day trading. So you got to find a strategy that actually matches your circumstance. Yeah, that's another mistake that traders make. They just pretty much follow the trend. Oh, Bitcoin is hot, let me go and trade and buy Bitcoin, right? If they say, day trading is cool, let me get into day trading. But you got to find a strategy that actually matches you and your circumstance. That's important. Yeah,
which means a lot of thinking again, right? Before you even decide what to place your trade, right? You need to think through all these things.
Yeah, I would say just dive in, make mistakes, and learn from there. I don't think anybody will think so much when they first start trading or investing. They just make mistakes and learn along the ways. Yeah. So that's where I come and share with you the common pitfalls, but you probably have to make them yourself before you kind of understand, that's what Rayner is saying about.
Yeah. Okay. So maybe we can just do a summary just of all the lessons that you have mentioned, right? Let's start from the first one.
Sure. The first one is not having it. So basically, let's talk number one. You must have an edge in the markets, right? A mathematical edge, right? And that's usually derived based on certain behavioral bias that cause the markets to that you can exploit to profit over time. For example, trend following is largely based on fear and greed in the market. Value investing is pretty much based on people overreacting and selling the stock down to a price that's below its intrinsic value, and value investors can profit from it. So yeah, you must have an edge in the markets. That's number one.
Okay. Then number two.
Yeah, you got to be committed, right? You have to pretty much go all in, not in the way that sell your house and everything, but pretty much mentally be prepared to spend years, 3 years, 4 years, right, to really understand what this business is about, right? To persevere through and to learn as much as you can and be open-minded. Yeah, number two. Number three is risk management, right? Don't go all in, right? Don't, if you have 100K, don't put 100K into one stock. Don't put 100K into one trade, right? Instead, apply proper risk management. So even if you're wrong on your trade, on your investment, you don't lose all your capital. Maybe you just lose 1 or 2% of your capital. It's fine. You can live to fight another day. So yep, have proper risk management. Number four is you must have the correct expectations, right? So if you come to the financial markets, right, I would say it's much easier to look to make money on a year-to-year basis. Not every year you'll make money, but if most years you can make money, I'll say you're pretty much ahead of the game. It's much more difficult to look to make money every single day or single week because, again, you need to generate high enough number of trades, right, for the law of large number to work in your favor. And if you have a full-time job, you have a family to look after, it's quite difficult to find so many trading opportunities, right, within such a short span of time. Yep. So, have the right expectations. Longer term, right, I would say it's much easier on your psychology, much easier on your mental state as well. And next one, number 5, is strategy hopping, right? No trading strategy, no investment strategy works all the time. Market is always changing. So what this means is that you can have a trading strategy that works in the long run, but in the short term, be prepared to see it underperform the market. See it, lose money in the short term. But if you stick to it for the long haul, right, then hey, you might have something that works. And one way to kind of help you overcome this because certain strategy don't work in certain market conditions. So one way to kind of compensate for it, right, is to trade multiple uncorrelated trading strategies that will help you, smooth out your equity curve over time. So for example, if you trade stocks, you don't have to put all your money in stocks. You can, diversify, maybe have a permanent portfolio. That's one. Maybe adopt another trend following approach. That's 2. And maybe number 3 is to, trade momentum stocks. So you have, different strategies which are uncorrelated with one another. And finally, the last one is a strategy mismatch, right? So know your circumstance, know your goal, right? And then find the appropriate trading strategy to meet your goal. Yeah. That's number 6, actually. Yeah. Yeah. So we have 6 tips.
Wonderful, right?
Yeah.
So Rayner just give you a lot of wisdom and essence, concise into just a few minutes, okay? And I realized that we have been, I always be very fearful when I talk about mistakes, okay? Because the conversation can become a bit more on the negative side, right? That what people are doing wrong, blah, 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 okay?
Yep.
So maybe now do you have something that's more motivating as a parting message for the audience today? Anything that usually you motivate your traders, your trainees about trading?
Yeah. So to me, this is a lifelong skill because once you kind of master it, right, this is going to pay you dividends for the rest of your life. If you're 30 years old, guess what? Another 40, 50 years, you have a skill that actually could potentially feed you for the rest of your life, right? So it's a skill worth mastering because it's yours to keep forever. So spend the time to invest in it. There's a lot of free resources out there. You don't have to, spend so money or what to invest in courses yet. Make sure this is something that you want, right? Go for the free resources. If you're sure this is something that you want, then you can take the next step forward. So basically the barrier to entry is low. Work hard for it because it's something that's going to pay dividends in the long run. Yeah.
Okay, so that is Rayner, and I feel guilty for taking up so much time. I promised you only 35 to 40 minutes, right? But now we are like an hour past.
Wow.
Okay, so
time flies. Okay.
yeah, thank you for your time. I think there are like one or two questions that we didn't manage to answer, but we will probably do it thereafter, right? We just leave a text answer on the page itself. So thank you once again, Rayner, and for all the free resources, right? He really has a tons of them, right? There are a lot of free e-courses that he has produced, guides as well as videos. Do visit tradingwithrayner.com. We have also put in the URL in the comments. The link is just there. You can just click and you can find tons of treasure that's on his site. So thank you, Rayner. Thank you for coming for this show.
Thank you, Alvin. Pleasure is all mine.
All right, we'll see you again.
All right, talk to you soon.
Cheers.